I'd like to welcome everybody. We have an exciting special edition of Down the Middle. This is being recorded on Non-Farm Payroll Friday, and I can't tell you how excited I am and how privileged you are, and I am, to have David Rosenberg with us. He is the founder and president of Rosenberg Research. We know him as Rosie, and we have long enjoyed the insights that he has provided. And again, I cannot be any more excited that we're here on Non-Farm Payroll Friday. So let's jump in, David. Welcome.
Thanks, Danielle. I remember the days when you and I would go on before the number with our good friend Sarah Eisen on CNBC.
Yeah, absolutely.
To talk about our forecasts, half an hour before the numbers came out. So it's a little easier to do the analysis post-report than trying to forecast it ahead of time.
Well, yeah, but I mean, look, let's jump in. Let's jump in. It's the mammoth miss. It is the mammoth miss. What's happening here? Our good friend Steve Blitz says that there are literally two jobs markets in America today. There's one that was affected by the pandemic, and there's one that's very permanent. You called out an increase in people who've been out of work for 27 weeks or more. What does this tell you?
Well, there's still a considerable amount of long-term damage, or what Jay Powell would call scarring to the labor market, coming out of the pandemic. So we have a rising share of people who have been out of work, looking fruitlessly for a job for at least a half a year. The number of permanent job losses took a very big leap up in the month of April. So you're still seeing a lot of the permanent damage take place in the labor market. That came through loud and clear in the household survey today. And look, there was a lot of other things that were very interesting beneath the veneer of just the weak headline, which was, the sort of things that Jay Powell told us that the Fed is looking at his last presser following the FOMC meeting. And of course, they talk about this incessantly as well, more inclusive approach towards, or holistic approach towards the labor market. So they're looking at the have-nots, as you said before. So a lot of the people that got hurt the most in the pandemic, they're waiting for that part of the jobs pie to come back first and foremost. And so from that end, you're looking at minorities. Actually, it was a negative number. There was a net job loss for minorities in the number today. For women, the same thing. For people without a high school education, and the youth, people between the ages of 20 and 24, all negatives. Those are the parts of the contraction that you saw beneath the veneer today. Mm-hmm. So all those things are telling you that labor market, you could argue, is in the process of healing still a year after the lows in employment, but there's still a long way to go before we're fully healed, many years.
So a 35-hour work week. I'll tell you, I've been traveling around the United States. I listened to people. We're both friends with Bill Dunkelberg, National Federation of Independent Business. A record 44% of small businesses say they cannot get a worker. You cannot drive a block. Texas, the Midwest, Florida, where I am, you can't drive a block without seeing a help wanted sign. So what is going on here? I mean, a 35-hour work week speaks pretty, that's a pretty big marker that backs the notion that companies can't get workers.
Well, I mean, you hear a lot about that, and I think that we're still living through this historical period of time. We're still not completely through the pandemic. It's nice to know that in the United States, more than 40% of the population are already been vaccinated. But that's still a process, and we're still not at herd immunity. And so you have a lot of people that might still be nervous about going back to the workplace for health reasons. You could still have people that are having difficulty even affording to have their kid in a child care. And interestingly enough, that was one area where employment was up last month. And we have a situation where, we have over 16 million Americans on at least one benefit program. Mm-hmm. And before the pandemic, that number was closer to 2 million in terms of people receiving at least one benefit. So here we are, the economy almost fully reopening, not totally, but largely reopening. We've got this gargantuan, GDP growth on our hands. And yet we have a situation where employment is lagging well behind for a variety of reasons. But I think that when you have 8 times the number of people on at least one benefit program, it does support, I'd say anecdotally, gives an ammunition to the view that these people that, we call them on the dole, or these people that are receiving these various very generous benefit programs are getting paid more to stay out of work than when they were working. And look, you can see that in terms of, what is the preponderance of the unemployment is really in those consumer service sectors that are low paying, low skilled. And that's where most of the unemployment has come from. And so when they therefore are getting paid not to go back to their old job more than they were making before, well, there's a big incentive. Mm-hmm. Not to go back to work. So I think that one of the things that jumped out of the employment numbers today was the fact that average hourly earnings were up 0.7%. But they were really only up significantly in those low-skilled, low-wage areas in consumer cyclical services, accommodation, leisure, retail. And so that's what companies are having to do. They got to pony up now, whether it's through pay sweeteners or just higher wages to bring these people back in. Well, look, we'll see how permanent it is. The one thing we know for sure is that these extended jobless benefits will expire by the end of the third quarter. Mm-hmm. Whether the administration and Congress wants to roll these over, it'll be situational. But I would say, to answer your question, and look, I know that I'm taking my time answering it, is that we're still living in the pandemic. We're still living it. This is still, historians will be writing about this period we're in right now. I'm not talking about a year ago or 6 months ago. We're still living through this experience. And so there's tremendous distortions in the economic data. And so the answer to your question is, yes, people are being incentivized not to go back to work. And even after companies paid up to bring people back in, there's still a mountain of unemployment in these particular sectors. So who knows what it's going to take to bring them back in. Probably more signs that the country is vaccinated. That'll provide some confidence from a health perspective. And why don't we give it time and see what happens after September? If these generous jobless benefits roll off, probably we'll see a lot more people come back to work. And look, that's only, 5 months away. But that I think is I quoted Cosmo Castorini in one of my pieces recently when he's telling Loretta in the kitchen from the movie Moonstruck that everything is temporary. And so this situation where we're seeing some wage growth to bring people back in, I think that, again, is going to be temporary. Mm-hmm. And I think once the jobless benefits go back to normal, we'll find a lot of these people that were, willing to stay in the sidelines and not working will come back in. That's my...
Yeah, it was interesting. Last night, the Hyatt that I stay at here in Florida, it was the bartender's first day at work. And I said, man, you're a regular patriot. And he said, well, I know I can make more sitting at home. He's like, but there's something to be said for karma. And I'm like, okay, all right. Well, I'm happy to meet you. And I gave him double the tip that I would otherwise. And that's just, I think you're right. September the 6th is around the corner, and that's when these benefits expire. And I like to think that summer jobs, that some of these jobs will be appealing to teenagers when, after Memorial Day, when they get out of school. So I'm kind of in your camp with let's wait and truly test, because you've got some fascinating numbers on the sheer number of the true pool of unemployed. Can you walk us through that math?
Well, look, when you tally up all the idle labor resources in the U.S., mm-hmm. and it's not just a simple case of looking at the official unemployment count. Because actually, when you look at the employment number that came out today, the vast majority of those people coming back in and getting a job was actually not the unemployed. It was people who were actually previously not in the labor force, but were waiting on the sidelines, not technically counted as unemployed. So you have to take a look at the entire picture of idle labor resources. And it's not just the number of unemployed. It's the number of people who are technically not counted as part of the workforce. So they're not part of the unemployed, but they're outside the labor force. But if they were offered a job, they would take one. Well, those are the people that actually got the jobs last month. Mm-hmm. So you have to take a look at the number of people who are not in the labor force, but would take a job if they wanted one. You want to take a look at the millions of Americans who are working part-time, but want a full-time job. That is actually an excess capacity in the labor market. Remember, when you talk about a 6% unemployment rate in the U.S. Or any country, the statisticians are treating a part-time job the same as you're treating a full-time job. So you have to take a look also at the number of people who are working part-time but actually don't want to work part-time. They want a full-time job. And you add that in. And you end up coming up with a number, when all is said and done, the total pool of available labor is about 17 million. It's 7 million deeper than it was when the pandemic started. So, all this talk about, shortages of labor, really, we have a U6, the broadest measure of unemployment, is 10.4%. A tight labor market is when that metric is closer to 8%. Mm-hmm. We are light years away from that. So there's probably a variety of factors related again to the pandemic and the policy response to the pandemic that is not allowing that pool of labor to be fully unleashed for the business sector. I'm not convinced that's a permanent condition. I imagine that, look, if the government wants to continue to roll over jobless benefits the way that they are, or we move to some universal basic income situation, if the U.S., if Americans voted in Joe Biden, if Americans voted in Joe Biden thinking, thankfully, he's going to take us into a European model, okay, well, go for it. But I think a lot of this is temporary right now. I'm just saying, we could talk about, company calls and all the lamenting about job shortages, and you mentioned Bill Dunkelberg, and so the survey data. But, how do you square that with the actual hard data? Mm-hmm. How do you square labor shortage with a 10.5% U6 unemployment when you know from history that the tight labor market only really coexists with an 8% U6? So I think there's a lot of temporary developments that are related again to the pandemic and the policy response to the pandemic, and maybe we're in the 7th inning or 8th inning, but we're still part of this game. But it's hard for me to wrap my head around all the anecdotes and all the lamenting and all the survey data and all the diffusion indices with the actual number of idle labor resources in the United States. Something tells me that not today, but by the fall, we're going to see a lot of that excess supply come back in the market. Mm-hmm. By the way, that will be disinflationary, not inflationary, although so many people can't see past the tip of their nose. They focus on the trees and they can't see the forest past the trees. But this idle labor, will ultimately come back in once the incentives that the government created to keep them on the sidelines start to dissipate. It's just a matter of timing.
Well, and I think that there are plenty of companies, lobbying on Capitol Hill saying, no mas. We don't want to pay up for labor at 60% of our cost structure. So I think the political winds will also shift in favor of companies that butter the bread inside the Beltway.
Let me just say this. I don't. Again, you can find there's gaps between the rhetoric, the anecdotes, surveys, and the actual data. And today's New York Times ran with the op-ed piece from our good friend Paul Krugman. who's joined us several times for your famous dinners in New York. And he wrote a piece today that, I highlighted in my breakfast with Dave about this was the best read of the day, where he was talking about what we're talking about right now. And he had a Wells Fargo report from February 2013 with the headline screaming, labor shortages everywhere. Companies can't find enough labor. We've hit the wall. Inflationary. Wages are going to... That was February 2013, Danielle, the same thing. So there's the belly aching, the lamenting, the surveys, the anecdotes, the Bill Dunkenbergs. But, the reality is that the report that he cited from Wells Fargo, February 2013, and the expansion kept on going for almost another 7 years. The unemployment rate kept on going down. And guess what? We never hit the wall on labor.
Yep.
And we never got the accelerating wage growth. Go figure.
So you and our fishing buddy, Philippa Dunn, you do a great job of getting all the way in the weeds. And sometimes the weeds tell us more than kind of the headlines. And you brought up some historic moves in the diffusion indices. Can you kind of explain what the implications are? Because the moves were big.
Yeah, we had, they're down to a 3-month low, but we had precipitous decline, and it's only happened, I think, 3 other times in the past where the diffusion index went down as much as it did, from the high 70s to around 60%.
And just to explain, that's the percentage of companies that are hiring.
Yeah, the diffusion indices and these payroll reports is a measure of dispersion. What percentage of companies or industries are actually adding to payrolls, and that number went down a lot. So it's telling you that that only barely more than 50%, almost 60%, were actually adding jobs. 40% weren't. That's not a very good number. And so what it's telling you is that there are still lots of industries out there and lots of companies within industries that were still shedding labor. I'm trying to, again, it's interesting that we're supposed to be having a booming economy and we're reopening. I was looking at the level of unemployment in every single industry in the United States. It's so far above where we were when we were at full employment in the last cycle, back in early 2020. Yep. There's not a sector that doesn't have an incredible amount of slack in terms of unemployment. So that was what was surprising to me is that, we're talking about the diffusion index. All the jobs that were created were in areas that you would think would benefit from the reopening, and it did. We had job gains in leisure hospitality and amusement parks and retail, casinos and gambling and hotels and motels. That was all the job gains. And that's, I estimated that was 20% of the employment pie, created all the jobs and then some. But what about the other 80%? Like there was no growth in construction. No growth in construction. Well, of course, part of that is because you had gains in housing-related residential, but non-residential was very weak. What happened with manufacturing? These unbelievably great ISM indices and manufacturing payrolls were actually down. Admittedly, a lot of that in the automotive industry. I'm looking at trucking, down 2 of the past 3 months. Very highly cyclical, sensitive area of the market. Stocks in the S&P are going to new highs. And maybe that's an area where they're having trouble finding workers. Although, once again, I looked industry by industry at the pool of labor in each industry. And maybe they're all getting unemployment benefits and don't feel like going back to work. Or it could well be, like I said before, what we don't know for sure is how much residual fear there is. Nice to have the vaccination rates above 40%. We don't know. That's the other part of it. Like, I know we're going to Capitol Hill and complaining to the government. But at the same time, I'm running a company. I'm running my own company. I'm pretty sure that if I opened up downtown, we're all working remotely right now. I'm not so sure everybody want to go back downtown at this stage. And of course, Canada's vaccinated at a fraction that the U.S. has. But there's that lingering. Like I'm saying, we're still, we're still living in this pandemic, and people are expecting that we're going to have normal employment conditions, normal economic conditions, just because things are reopening. Not everything is fully reopened, but there's still part of that fear factor. back to the diffusion index is telling you that there's lots of industries out there. Like, take a look, for example, like why would you tell me why the financial industry never really lost jobs in this.
Mm-hmm. That's right.
That's one area where, so why would you expect right now, is the financial sector adding jobs? No. So that's one of the reasons why the diffusion index was weak. Why would financials be adding? Or does real estate agents, do we need more of those at this stage? So there's so many other parts of the economy that didn't get hurt by the pandemic. Mm-hmm. And they don't need more workers because there's no pent-up demand there.
Yep.
So that's the other element of this, is we're all looking at the job gains. Job gains where? Yeah, restaurants and movie theaters and theme parks and hotels. But there's so much of the economy on the merchandise side that never got hurt, that didn't even suffer any job loss. So why would you be expecting that those would be areas where we're going to be seeing job growth? So that's one of the factors, impairing that diffusion index that we're talking about right now.
So, there was a lot of celebration on Wall Street because jobless claims broke underneath 500,000 for the first time since the pandemic. I'm sorry, but 500,000 is still, historically speaking, quite a big number when you consider what the starting point was.
Well, yeah, I wrote about this the other day. You'd be thinking that with all the jubilation and all the reopening, and that it'd be zero. Like, that's the other thing I'm trying to wrap around my head. For all the belly aching, lamenting, blaming, can't find labor, and yet we get jobless claims, and people talk about, well, look how far down they've come. Well, no kidding that they've come down with an improving economy. But why aren't they at zero? And that's an extreme comment. But in a normal economy, jobless claims in any given week is around 200,000. Mm-hmm. So you're quite right. We're more than double what a normal. Why? And remember that jobless claims are a flow of firings. That's all they are. They are a flow. They're not a stock. So you're talking about a change on a change. So the change on the change is going down, but the change itself is more than double what a normal economy is. So, I come back. For those people that say we're going to blame government, we're going to blame jobless benefit packages. Maybe that's all true. You hear a lot about that. But then somebody else will go back and say, well, if that's all true, why are you firing people? If you're having so much trouble finding people to work, why are you firing people 500,000 in a given week? And that's supposed to be a good week. So you see, that's what I'm talking about. It is very confusing. It's confounding. I keep on coming back. We are not in a normal period of time. Mm-hmm. Thankfully, we're past the eye of the storm. The vaccinations were a game changer. We are not out of this thing by a long shot. And I don't know why people think that anything's coming back to normal or that quickly. And that's what the data are telling you. You got people saying, I can't find workers. At the same time, jobless claims are 500,000. Well, so don't let those people go then, and you won't have a problem, with the job shortages. So there's a tremendous amount of inconsistency in the data, and there's actually even more inconsistency between the narratives that you're hearing today and the data.
So I'm going to go there, Dave. I'm going there. I'm going to hit the inflation button. Again, you mentioned the ISM. Prices paid are being reported at record highs, whether you're talking about manufacturing or services. Commodities inflation is through the roof. The supply chain disruption, I say supply chain disruption in my sleep at this point. Shipping, freight costs. Companies, are they imagining this inflation? And by the way, China's sitting on record levels of a lot of these commodities.
No, I'd say that we do have inflation right now, but it's, I spent probably 80% of my career actually disagreeing with the Fed. But I agree with Jay Powell on this. I think that he's right. I think that we are having a temporary bout of inflation pressure, but it's temporary. And if you're a central bank, you're not going to change policy based on a deviation around a trend line. You'll change policy if you believe that trend line is changing. Well, let's go back to your comment about the ISM, prices paid. It's actually at its highest level since the summer of 2008. Let me just tell you something about the summer of 2008, Danielle, because oil prices, WTI got to $140 in a short time period. In a year, it more than doubled. It was $140, not $65. And I went through a lot of internal pressure in the summer of 08. If you remember the summer of 08, everybody thought that Bear Stearns was behind us. Everybody thought that the housing correction was behind us. If you remember, everybody thought the recession was over. The European Central Bank in the summer of 08 under Trichet raised rates, and Bernanke actually switched to a tightening bias because of inflation, commodity inflation. And the ISM prices paid index, by the way, is not a leading indicator. It's just telling you if you want to draw the ISM prices paid against the CRB, it's the same chart. It's not a leading indicator. I don't know why anybody would take the ISM prices paid and extrapolate from it. I mean, were you doing that last year when ISM prices paid was down at the floor? Would you have been saying we're going into a pernicious, sustained deflationary environment? And would you be saying it today at the peak? But remember, we're back at the levels back we were in summer 2008 when the narrative was basically pretty well the same. The shock is over, and we know for a fact that it wasn't over. We didn't know that Lehman and AIG was lying around the bend. You know, you read the financial stability report, or what I call the financial instability report that was just published yesterday. You know, I'm more concerned about excessive asset inflation, and if that rolls over, what that's going to mean. You know that people, the inflation rate got to 5% in the summer of 08, and people are going crazy over inflation without realizing it's a lagging indicator. So the ISM prices paid, yes, the highest level since summer of 08. The summer of 08, inflation was 5%. Did the ISM prices paid tell you in 12 months' time that inflation was going to negative 2%? How do you know? Danielle, how do you know that inflation is not going to be minus 2% a year from now? Now, I'm not going to say that we should have the answer to that question, but I would not be looking for the clues from the ISM prices paid, which is at the same level it was in the summer of 08, at the peak of the commodity cycle. And a year later, the commodity cycle, as commodity cycles all do, there's only been 15 of them since 1950, that's all. You look at the year-over-year chart of the CRB, it looks like a series of sine waves. So no, I don't have a big inflation story for you. I think that we are living in this unusual period of time. It's not over. There's been all sorts of distortions with the pandemic, distortions with the reopening, distortions with the vaccinations, previously the lockdowns. It's been a roller coaster ride. But remember that the initial impact of the pandemic last year was that it was a much more acute demand shock than supply shock. So March, April, May of 2020, CPI printed negative. Mm-hmm. Was it temporary? Yes. And now we're printing some hefty increases, and it's not just base effects. There's other things going on. And so we're going through a temporary period of inflationary pressure because now with the reopenings and the fiscal juice, and the fact of the matter is that now demand is running well ahead of supply. And we're getting some near-term inflation. Well, what's the Fed? So the Fed's going to raise interest rates. Fed policy hits the economy with lags that are 12 to 24 months. And if the Fed believes this is all temporary, then why would you change policy on something you believe is transitory? Now, look, maybe there's a chance that they'll be wrong. But we have to understand, we've got a significant demand boost from what? From what? From stimulus checks. And that impact's going to run out. The jobless benefit impact will run out. This is all happening in the third and fourth quarter. So demand naturally is going to subside. And I find it disingenuous to suggest that we'll have reopening and it will only have an impact on demand, but no impact on supply. But we're going to have an impact on supply. And I can tell you that, yes, we have shortages right now. But I'm looking at the container data in the ports of LA and the ports of Long Beach, the two busiest ports in the United States. They are filled to the brim of merchandise ready to be unloaded. So supply's coming back. I'm hearing all about semiconductor shortages. Well, I'm looking at the export and shipment numbers out of Korea and Taiwan. They are through the roof. I'm looking at Canadian lumber production through the roof. So to suggest that supply is not going to come back online with a lag, to me is nonsensical. So yeah, we have a near term and I would say a temporary inflation situation, just as a year ago we had a temporary deflation situation. But do I think it's going to be long-lasting or persistent? I have a tough time believing that, and I'll tell you, it's only because, taking a look at the degree of excess capacity in the economy now, trying to estimate where the output gap is, that's always a very difficult thing to do. But we have an industry cap-U rate of 74%. We have a U6 unemployment rate of almost 10.5%. And the only two times in the past we had that condition in the product market and labor market was in late 2001 and the summer of 2008. And they did not produce an inflationary outcome for the next couple of years.
So, the predictions are that car sales and home sales are just going to continue at this insane clip going forward. But you've got some pretty cogent insights into you can't ring the bell twice. We're not going to see what we saw in terms of households purchasing goods all over again.
Well, I went back through the history to see the last time, for example, the last number of times that auto sales were 18.5 million units. There was a very strong April. And they were down in the next 6 months precipitously each and every time. We brought forward a lot of consumption. And the same is true with, over 1 million on new home sales, 1.7 million on housing starts. These are all back to levels we had in 05 and 06. We brought forward a lot of consumption, but not just in housing and autos, but, durable goods in general. One of my premises has been that, yes, we're going to have the big party. I have a trouble with the concept of pent-up demand in services. That doesn't really exist.
Wait, Dave. But there's all this savings on the sideline. There's pent-up spending because the saving rate is at the highest in, the history of mankind. Blah blah blah. Right. I'm egging you on.
Yeah. Well, let me get to the part about. Let me get to the savings rate in a second. But we're going to have, and it's already starting. You saw it in the consumer spending report. That we got for March. It's already starting, that you're seeing service sector spending, which collapsed last year, coming back. I wouldn't exactly call it pent-up demand because you're not going to make up for that. You're not going to go to the restaurant 6 times every day for the next several months to make up for the lost consumption last year. Right. You're not going to get your hair cut 4 times a day because you didn't go to the barber last year. So it's a nebulous concept about the pent-up demand in services, but it's going to come back. But remember, it's an $800 billion or 4% chunk of GDP. We're having a jubilation celebration amongst the economists over a V-shaped recovery and 4% of GDP. Go knock yourself out. But the $2 trillion chunk is consumer durable goods. And over the past year, that spending in volume terms is up 44%. We haven't seen something like that since 1950. So we had, because of course, we couldn't go out, we couldn't go to restaurants, couldn't travel. So, people spent money on their homes or they bought a new car. If you saw the data on pleasure boats, pleasure aircraft, furniture, appliances, electronics, home remodeling, that you would not have ever guessed we had a recession last year. Durable goods spending normally goes down in a recession, and it's skyrocketed. So I would say that there is no pent-up demand for a share of consumer spending that's double what consumer cyclical services are. This is almost a $2 trillion market. It's completely satiated. Now, I can't, you will not convince me that all these stimulus checks are going to be used towards another dining room table, because you already bought one last year. Are you going to fit 2 tables in your dining room? Are you going to build an extra swimming pool? Are you going to remodel your basement again? All that stuff is done. Again, I said this is a very unusual time in history, but there's no pent-up demand. I'd say there's actually pent-down demand in a nearly $2 trillion chunk of consumer spending called consumer durable goods. We are hit the satiation point. I have a chart in my presentation package that shows household durable goods assets per capita. That chart looks like a dot-com stock from 1999. And so no one talks about what's going to happen to that part of consumer spending, even as we go and we fly and we eat out and we go to museums and so on and so forth. So the other part is your comment about the savings rate.
Mm-hmm.
And of course, that's the lingering impact of all the stimulus checks. So the savings rate right now, let's call it roughly 30%. The pre-COVID equilibrium was more like 7%. But who knows where the savings rate is going to be going? I mean, who knows where it's going to be going? You see, everybody talks about this dry powder for spending, but I'm asking you, Danielle, where are you going to spend it? Where are you going to spend it? Are you going to say, well, I'm going to stay at the most expensive hotel on my trip? I'm going to, I'm going to eat out at the best restaurant. Where are you going to spend it? Because you've already spent so much on durable goods, which is such a bigger share of consumer spending. Where are you going to spend it?
Well, right now they're spending it on homes.
The thing is that you can take the horse to water, doesn't mean that the horse is going to drink. I think people have underestimated how high the savings rate is going to be for a long period of time. And let's not forget that the fastest growing share of the demographics are people 65 and up, and that's going to continue for the next 10 years. So people will also be thinking about their retirement. But let's just say, stick to the facts. The facts are these. The facts are that the New York Fed has done the work for every single economist out there. They looked at where the money was spent. They followed the money through stimulus check number 1 under the CARES Act, stimulus check number 2 under Donald Trump signing on to the $900 billion on December 27th, and now this latest one under Joe Biden. And the numbers hardly move. Less than 25% of the stimulus checks go into actual spending. And maybe that's what somebody said to Joe Biden, said you got to go big because so little of it actually goes into the economy. So a third of it is going to pay down debt. I'm looking at the numbers on bank lending. Now you got these bankers, they're smiling, their stock price has done great. We saw their bank earnings numbers for the last quarter. So where are they making their money? Outside of unleashing loan loss reserves. They're making it in capital markets, wealth management, and trading. Their loan book is going down. I'm looking every week at the bank lending data, and not just to businesses, but to households. It is undergoing an epic contraction. People are actually paying down debt. And so less than 25% of this money that they're getting, this windfall from the government, is actually going into the real economy. Now, it's still a big number. It's going to subside at some point. But it's an interesting comment on behavior that less than 25% of this stimulus is actually going into the economy. And the rest is being split between debt pay down and saving/investment. Saving/investment, which is, your Robinhood account. So that's really what the story here is. We have actually, in the overall context of how gigantic the stimulus is, and the impact it's had temporarily on personal income, which is without precedent, bigger than LBJ's Great Society. It's interesting that less than a quarter is being put into the economy. What happens when the well runs dry, Danielle? Mm-hmm. And so I'd say that people will be surprised at how high. Now, it's not going to stay at 30%. People will be surprised how high the savings rate is going to be for a prolonged period of time.
So, step back into your old role as the housing expert. What is going on? I mean, I know friends who are bidding up homes like insanely. I'm baffled at some of these home prices right now.
Well, it's like in an era where interest rates are very low, long duration assets do very well. You're even seeing the growth stocks come back. Now that bond yields have come back down. But you've got very tight housing markets, and you've had a shift in preference coming out of the pandemic for home ownership. And people are looking at their house differently. They're also looking at their house as their workplace. Much like I have here. I'm at home right now. This is my office. So lots of secular changes are taking place. There's not a lot of supply. The new home sales numbers don't lie.
Yeah.
Over 1 million units. We haven't seen that, since the boom years when I was back in Merrill, back in 05 and 06.
Yeah.
So we have a supply-demand mismatch. You could argue that there's also quite a bit of speculative activity going on. And I say that because when you look at the data, only 30% of the home sales are actually coming from first-time buyers. A lot of it are all cash investor deals.
Oh, they're pension funds. They're coming from overseas. It's insanity.
But the problem I have with housing is just more of a valuation. More of a valuation. It's the same thing with the stock market. I have nothing against the stock market. It's just in this auction, it's become so expensive. People will say, well, there's a guy who knows the price of everything but the value of nothing. But the reality is that the same house, quality adjusted, is rising double digits. And no, that doesn't make a lot of sense. Usually housing, you always talked about residential real estate as an inflation hedge. Yeah, because it usually would appreciate with inflation alongside a 1 to 2 point premium over inflation. And now that premium is more like 15 percentage points. You look at house prices normalized by the CPI, and we know the CPI is rising right now. Look at home prices normalized by rent. Home prices normalized by income. So you take a look at housing with a classic PE ratio. And Danielle, these are all the charts I was looking at when I was pounding my fist on the table over the housing bubble, back in 06 and 07. And I'm an adherent to Bob Farrell's 10 market rules to remember. Everybody knows that. Rule number 1 is that markets tend to return to the mean over time.
Yep.
Now, not levels, but everything I'm talking about here are ratios. We have a housing market in the United States, nationwide, where prices relative to their underlying fundamentals are more than 20% overvalued. What would that mean to have a 20% correction in home prices? And then the same thing with the equity market, which is more like 30% overvalued. And it was interesting to see, actually, in the financial instability report that the Fed just published, that they came out and said that actually the stock market, even when you adjust for interest rates, is trading at exuberant levels. And so I'm a little, and this comes back actually, talk about housing. I'm looking at the whole household balance sheet. We're at it again. We're back to relying on asset inflation as a source of prosperity in the country. And it's troublesome. When I take a look at household net worth to disposable income, it's up to 770%. We're already 100 percentage points higher on that ratio than we were at the peak of the housing bubble back in the late 2000s, and we're 150 percentage points on that ratio than we were during the tech craze back in the late 1990s. It's never been this high. And the San Francisco Fed back in early 2018 put a report showing how the household net worth to disposable income ratio is a mean reverting series, and it is. And I shudder to think what happens if that does end up mean reverting. And the asset deflation we're probably going to see is going to knock this consumer inflation story off the front pages of the paper. And I think everybody should go and read what the Fed published yesterday on their financial stability report. I call it instability as a bad joke.
As a former...
but people are looking at the wrong thing. They're looking at the wrong thing. If you were looking at this unbelievable nosebleed net worth to income ratio instead of oil prices in 2008, your investment performance in the next year would have been a lot better. People are looking at the wrong things. They're looking at yesterday's story, which is the year-over-year percent change in the CPI and what commodities have done, without understanding that supply is going to catch up. What they aren't factoring in is in fact what the Fed was talking about yesterday, which is that we do in fact have bubbles. They might as well just use the word bubbles, but they can't use that word.
Well, look, I
got to tell you, when these bubbles burst, Danielle, we are not going to be talking about inflation any more than we were coming off $140 oil in the summer of 2008.
Look, Dave, as a former Fed insider, I cannot tell you how rare it is to see such plain language in the financial instability report. I mean, the Fed has made an art of dancing around the discussion of valuations for generations. So when they come out, like they did, like Lael Brainerd did, and she's the presumed front runner if Jay Powell's not renominated. I mean, it's a rare moment to see Fed officials be so blunt.
Well, it started with Powell during his presser in the Q&A when he used the word froth not once but twice. Mm-hmm. And he no longer, as he once was, is justifying equity valuations based on where interest rates are. And of course, it wasn't just the stock market, but it was also the SPACs and the IPOs, leveraged hedge funds. Look, we have a situation on our hands. Everything is just smacking. And it's funny to say because, we're a year past the bottom of the stock market, a year past the bottom in the economy and employment, but it's still in the context of this very unusual situation we have in our hands. I would actually argue that maybe the biggest bubble out there is in corporate credit. I mean, how can we call it a high yield market when the interest rate in the high yield market is barely more than 4%? You've got a situation where the spread between triple C rated debt and single Bs, triple Cs of course are distressed, the tightest levels they've been since 2007. Well, we all know about 2007 in hindsight, is basically peak of market, peak of cycle. So everything is just screaming bubble. But I would say that amongst everything else we're talking about right now, the high yield market, the distressed debt market, everything that has to do with the riskiest tranches of corporate debt, that is an accident waiting to happen.
Mm-hmm. Well, if that's an accident waiting to happen, and we'll wrap up with this, you did some interesting math about love in the long bond. I mean, right. I said, how many percent? What? I looked back and I almost shot you a text to ask if it was a typo. But walk us through.
Sure. Well, look, you know that everybody talks about the TIPS break evens. You can't open up your Bloomberg terminal, turn it on every morning. The TIPS break evens, the inflation expectations of the bond market haven't been this high 10, 15 years. It's record highs. And so the TIPS break evens, depending on which maturity, 2.5, 2.6. And so the market's already priced for the inflation, the peak inflation of the last cycle when unemployment was 3.5%. We're nowhere near that, but the market's already priced that in. Look, when you're taking a look at the TIPS break evens, what are they correlated with, Danielle? They're correlated with the CRB index, okay? To the bond trader in the futures and option pits, their inflation model is a one variable model, and it's got the CRB index, okay? When you go, the Cleveland Fed every month produces its own model of inflation expectations, going out maturities to 30 years. And when you look at 5 years or 10 years, and of course they moved off the bottom, but they're roughly 1.6%. But you see, the Cleveland model is like a real model. And that has at least a correlation with the labor market. Because how can you do any inflation forecast without 70% of the cost structure called labor in there? So the Cleveland Fed model is actually a real model. It's not a one variable model. But their inflation expectation from their model is 100 basis points lower than it is in the current bond market structure. So my comment was this, and it's just pure math, and it's an if. It's an if. If the market-based inflation expectations out of the TIPS market converges on where the Cleveland Fed is, it takes the long bond yield back to where it was in September of last year. I'm not saying that we're going back to September of 1933. I'm saying we'll go to September 2020 in that environment. And because of the law of low numbers and convexity as it relates to total return in the bond market, the 30-year Treasury would generate you within a year a 27% total return, under the proviso that I'm right, that the convergence is with the TIPS break-evens lining up on top of Cleveland Fed inflation expectations. But that's a very interesting and actually unprecedented anomaly between these two data series.
Well, look, just slice it down the middle. It's still awesome, seriously. So, all right, look, I can't thank you enough for doing this last minute. I'm so excited we got to visit. I hope everybody else is as enlightened as I am. It's always great when you're this energetic, and I look forward to you getting that second vaccine and you get in an airplane. But again, thank you so much for your time today, Dave. We really do appreciate it. Take care.
You too, Danielle. Thanks for inviting me on. All the best.
Thank you. Thank you enough for joining me for this special edition of Down the Middle. I mean, to have David Rosenberg on Non-Farm Payroll Friday when the data just literally went haywire. And 1 month does not make for a trend, but still, what a treat. I hope you enjoyed it as much as I did. I hope you learned as much as I did. And, score one for the contrarian thinker. And that's kind of how you have to be in these kind of investing environments. You have to think differently than the crowds. So, I look forward to the next time that you join me. Thanks once again for being with me. This is Danielle DiMartino Booth with Down the Middle. Thank you.